So this past week, had the opportunity to be the featured speaker at a luncheon hosted by Heart of Florida United Way about planned giving. So on the show, we thought we would share with you some of the strategies that we talked with the luncheon crowd about this past week, and perhaps give you some ideas and thoughts on how you might implement better charitable giving strategies, not just now, but in the future. And then joining me on the program, who also came to the luncheon with me as well, Christina Lamb, survivor of another tax season as an IRS enrolled agent. How are you doing?
Yes, I am doing okay.
Okay.
Yes, thank you for having me.
Well, that is good. I think I've been a little cranky this week, but that's okay. That's a personal problem.
Well, it's probably allowed. I mean, you also made it through the tax season.
Correct.
So
yes.
I think we all can take a sigh of relief now that it's over.
Indeed. Although you do have some good things to talk about with our listening audience this week.
I do. I put together a list of the top items that we saw causing some tax trouble spots this year, and just to help you plan in the future to avoid those.
Yeah, no, good stuff indeed. So welcome on in to this week's edition of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of podcast channels as well, where we are a top 25 financial planning podcast. Also, be sure to visit our website at nelsonfinancialplanning.com. That way you can learn more about what we do each and every day at the office. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of folks like Christina Lamb, who happen to be certified financial fiduciaries as well, that stand ready to help you improve your life with a successful and cost-effective financial plan. So I guess kind of odd here in May to be talking about the end of tax season, but it was kind of a unique one for us here in Florida.
Yeah, a little bit of a blessing to help extend the tax season, and a little bit of a curse as well, but you know how that goes. But for Florida residents, because of the hurricane relief, as well as some of the other folks in other states affected by the hurricanes, the IRS designated the deadline would be May 1st for those affected by those hurricanes.
So a little bit of extra time, if you will, to kind of crank through and get your stuff organized. If you didn't get it done by May 1, well, then chances are you're on an extension, and by then you'll have to certainly hit that deadline of October 15th is the final deadline, assuming that they don't change that. For now.
And God bless no hurricanes.
Correct. Indeed.
We've had our fair share.
Because that can, in fact, and certainly this past year did change the deadlines. The markets also managed to survive, I guess, three sort of big headlines from this past week that were economically related as well.
Yeah. So GDP on Wednesday showed about a 0.3% decline from Q1. Not expected, but pretty much solely driven by businesses rushing to stock up on imports. Friday, we had the last day where Chinese imports could dock and kind of get in right before those higher tariffs start.
And avoid the tariffs on that. And I guess that was really the key piece of that GDP data, because the net export part of it, okay, bringing in more than what went out, wound up creating a difference of about 5 full percentage points when you kind of look through the numbers. That was the biggest drag from net exports since 1947, really going back to when they first started to make record of this. And it sort of makes sense, to your point, if Friday was the date to get everything to the dock and avoid the tariffs, then obviously folks were bringing in a lot more than they were sending out to try and be ahead of that. And then, of course, Friday, you had the jobs data as well. And so what was interesting about that, and that was obviously getting closely watched, because that covered the month of April, sort of the first economic reading for the month of April. And that, of course, was when all of the conversation about tariffs and whatnot were taking place. And lo and behold, job creation actually pretty strong, 177,000 jobs, not too far off of the prior month of 185,000, and certainly well above the expected gain of 133,000 jobs. So employment data looked good. Unemployment rate held at 4.2%, and an interesting economic barometer that I think people were really looking at, given that it kind of had that whole of April in there, and obviously the backdrop of these tariffs. So some interesting things on that front. So that's headline number 2. Headline number 3
is corporate earnings. So they're continuing to hold up. The biggest bellwether was Microsoft on Wednesday, stating 13% growth in revenue, followed by Facebook announcing 16% on sales growth. So part of our Magnificent Seven is still really holding strong.
Yeah, some interesting results, and obviously a lot of the kind of the forward-looking statements you heard from corporate America as earnings season continues to roll for the first quarter of the year is that a lot of uncertainty, obviously given the current climate, but at least through the first 3 months, businesses continue to generate revenue and generate profit. And so from an economic perspective, if you're kind of just looking at those sort of 3 data points, not too bad when it comes to what's going on out there in the world at large, that's for sure. So wanted to also kind of follow up, Christina, I know you were not with me on the program last week, but did want to follow up on a conversation that we had on the program last week, and I'm sure you saw the survey from T. Rowe Price, but what it said is that individuals with a formal financial plan were found to have 2 to almost 4 times more wealth when entering retirement than those that didn't have one. And I guess when you stop and think about that, that kind of makes sense, right? Having a plan is always a good idea, right?
Yeah, that definitely makes sense. I mean, a financial plan can help you figure out if you're saving enough for your lifestyle, if you're putting it in the right places. It can come down to diversification, allocation of your funds, and how they're invested. Obviously, when you're younger, you generally want to be more aggressive. As you age, you want to back that off a little bit. You can start to look into specific tax strategies, consider inflation, rising cost of things such as healthcare, things of that nature.
Boy, that last one's a big deal for a lot of clients these days.
Absolutely huge.
Yeah. No, indeed. And so what I wanted to just kind of cover a little bit is, so what's involved in that, in creating that financial plan? And it really is kind of, we would break it down as 3 steps, if you will. So the first one is obviously to define the goals. What is it that you want? What do you want to try and achieve? What does retirement look like for you? And the reality is that for everybody, that's going to be a little different. And so you need to kind of lay out when you're creating a plan. Always good to kind of lay out, okay, well, where do I want this plan to actually take me? So setting goals is the first part of that.
Yeah, and I think there's no magical number for anybody in particular. Your lifestyle may be different than my lifestyle. Your wants in retirement could be different than mine. So, we get a lot, how much do I need to save for retirement? And it really just depends very specifically on your wants and needs. But the next step would be to assess your financial situation. How much do you own? How much do you owe? Basically money coming in, money coming out. So in essence, creating a budget, or if you already have one, revising your budget, because those things change over time. As with all of these steps, you should be looking at them, we'd like to say every year, but at least every couple years, right, especially earlier on, and just making little tweaks here and there could go a long way to providing a more successful future.
Well, and that's such a great point. I mean, your financial plan is a dynamic document. It's a dynamic picture, and it's not something that you set it and forget it and then ignore. In that case, then it's always good to use a professional as well. I mean, ask friends, research online. We had somebody come into the office
that was interesting.
that found us on ChatGPT. So there's all kinds of ways in which to do that, or you could even read their book. In our case, our book, as we've mentioned previously on the program, Next Gen Dollars and Cents, featured last weekend at the LA Times Williams of Festival of Books out in, Christina's modeling the book for our YouTube audience right now. So check it out. And obviously that is a great tool to figure out how to create your financial plan as well. We're going to take a break here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. Really glad, Christina, you're with us today on this particular topic. This is some of the trouble spots in the tax landscape that you observed this past tax season.
Sure. With the May 1st extended hurricane deadline, we finally got that past us. So we put together the top 10 tax trouble spots that we've observed this year.
Sure. All right. So a top 10 list, a la David Letterman. For those of you who don't remember who he is, he was a guy who had a late night show, did a lot of top 10 lists. Anyway, I guess I'll take the first one. That is one that I think we're hearing a lot of conversation about, and my goodness, it seemed to be nearly every other return that we were looking at this past tax season. This was an issue, and that has to be the taxation of Social Security. The more you see your income sort of just trickle up, maybe it's because of more interest or just COLA increases or any of that, then the more we saw that Social Security was becoming more and more taxable. And it doesn't matter what income we're talking about, whether it's investment income or property income, any of those types of incomes all add. Doesn't matter what the source is, it all adds to create the threshold of which that triggers the taxation on your Social Security. So one of the issues, and we've certainly talked about it on the program before, is that those thresholds that trigger the taxation of Social Security have not in fact changed in 40 years. No, they were not ever even indexed for inflation. So that means that over time, you have a lot more Americans paying tax on your Social Security. Big conversation, obviously, in Washington about the taxation in Social Security, or should I say the first time we've sort of heard that being part of the tax conversation in Social Security. So stay tuned on that one. We're certainly hopeful that, I don't know that you'll see a full elimination of it, but maybe just an adjustment of that threshold to make it less taxable for a lot more Americans than what is happening today, that's for sure.
Or at least start incorporating inflation into the amount that's taxable. I mean, the tax code does that for so many things. That's one of the few items that's never been adjusted for. So our next item up is the premium tax credit recapture. So we still keep seeing this from several years ago. It comes back to the Affordable Care Act, where you're getting health insurance through the marketplace. And when you get insurance through the marketplace, there's the potential to receive a credit for that insurance based on your income. The problem is they make you calculate your income. So most folks really don't have a grasp on what that is. You know, they maybe just consider their W-2 and not all their sources of income, or, you know, if it's a husband and wife, they're not considering the whole family's income, things of that nature.
And you always think net. Right? You always think net, not gross. What's your income? You always think net, but the reality is that it's based on your gross.
Yes, very true. So if you incorrectly calculate your income, there is a possibility that you have to repay some of that premium tax credit back. Or maybe there is a circumstance that is unforeseen. You had to take some investment income, or maybe, you know, a job opportunity popped up and your income for the year changed. So, you know, those would all be circumstances where you would potentially have to pay back part of that credit. And we've seen some folks have to pay 100% of that credit, which unfortunately in some circumstances could be like $15,000 to $20,000.
It's going to be a significant impact on your tax return. Got to be really careful with that one. You're right, we continue to see that one being an issue. The other one we saw as an issue and this is probably more unique to last tax season, has to deal with higher interest rates, things like savings accounts, money markets. Finally, after years of not paying a whole lot of interest. Last year was a year where you actually made a good bit of interest in those types of investments. And then because of how well the market has been doing prior to sort of these past few weeks, the reality is that dividends, capital gains, those kinds of things also went up. The tech-heavy growth side, the Magnificent Seven, Christina, that you were talking about earlier, those also generated the potential for a lot of dividends, a lot of capital gains. And so you saw those numbers go up, and then obviously that's taxable, and then that certainly had a pretty significant ripple on many people's tax returns for this tax season.
Right. It actually flowed through to the first topic, whereas it's increasing your income,
Sure.
hence increasing your Social Security tax.
Right.
Well, the taxable amount of your Social Security. So our next is, are you making the right quarterly tax payments? So if you don't have tax withholding throughout the year, you're required to make estimated tax payments throughout the year. Now, those are based on your prior year tax return. So if you've had circumstances that change your tax situation from one year to the next, those quarterlies may need to be adjusted because they are based on what was filed in the previous tax year. So has your filing status changed? Did you go from married to single or single to married? Are you losing a dependent because a kid is coming off your return, they graduated from college, or maybe you have a new bundle of joy and you're going to have another dependent? There's a lot of different things that can change. Changes in investment income,
Sure.
The capital gains is a big one. So one benefit to really having a tax professional is that they would have the ability to have that conversation with you and notice those changes and make adjustments to your estimated tax payments to make sure you are making the proper payment and certainly not overpaying the IRS, which none of us want to do, or therefore underpaying as well and getting hit with a little penalty.
Yeah, no, and certainly with interest rates where they are, I mean, that interest and penalty charge can really add up. So you certainly want to be careful on this one. And another one that sort of resurfaced this year after a few years of absence, if you will, is this notion of being able to deduct student loan interest. Now, not that the student loan interest deduction went away, but most people wound up finding that as a result of COVID, that their loans wound up going into deferrals. So that meant that if you're not paying on your loan, then you're not having any interest deduction. And that certainly started to come back with sort of the suspension of those deferrals and a decent deduction that you wind up being able to take on your tax return for that student loan interest. The tricky part is that you might have to seek out that tax document. That interest generally gets reported on a 1098, and you might have had to kind of look around and see and find that document online because more and more people aren't mailing these things.
Yeah, absolutely. And that's our next tax topic is tax forms no longer coming in the mail to you. So many times I've had conversations with clients going round and round, people swearing they never got the tax form, they don't have it from XYZ company. But I'll sit there and look at their tax return, know their circumstances, and basically have to negotiate with them or try and finagle them to call the company and, realize just because they didn't get the form in the mail doesn't mean it wasn't issued. You got to check with all your companies and make sure, or even go online. Because here's the thing, the IRS doesn't care that you didn't receive the form. They just care that it was reported to you and you have to pay taxes on it. So many companies are no longer sending those out in the mail. That's what we're finding. You have to go to their online portal and download it or print it or whatever the case may be. You may even have inadvertently told them not to send you the tax form by going paperless. And a lot of people just don't even realize that.
No, and that's a biggie. And I think people kind of forget that is, the days of getting all of this in the mail, it's over. So it's on you. The burden is on you to track down and find those tax documents. And I know, Christina, as you were saying, you worked with clients to try and find where it is. And those tax documents sometimes can not be easy to find when you're in the portal looking for all of that.
Very true.
Anyway, we're going to take a break and continue the conversation on kind of these tax hot spots that we observed this past tax season at Nelson Financial Planning. This is Joel Garris and Christina Lamb here on Dollars and Cents. Welcome back to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. On this segment, we're continuing the conversation of those tax hotspots that we observed this past tax season with none other than one of our fellow certified financial fiduciaries at Nelson Financial Planning, Christina Lamb. Also happens to be an IRS enrolled agent, so certainly able to speak directly to these issues. And the one we were talking about before the break, man, that's a toughie, because some of these tax forms are hard to find, and they're not mailing them anymore.
Yeah, absolutely. Tax forms are generally that they're not mailing anymore. You have to either call the company or go online to obtain the form. A hard one that could be a Social Security. Many folks,
Right.
especially the clients we deal with, that involves like waiting online or waiting on the phone for an hour just to get to an agent to talk to somebody, or dealing with their portal. So it's definitely becoming increasingly difficult to get those.
I mean, let's face it. There's a lot of folks that are not tech savvy, didn't grow up around it, and those are the ones where it becomes a struggle to figure out and pull up those tax documents. And unfortunately, as a result of all of that, which kind of leads us to our next topic, is there's certainly a lot of tax scams out there. Each year, if you're a regular listener to the program, you know that the IRS releases a list of sort of its dirty dozen tax scams after the season ends and they process through stuff. Christina, you and I always kind of do that as a show.
Yep.
So our listening audience will have that to look forward to on a future program as we kind of go through that. But just generally, there's a lot of bad folk out there, and they use your Social Security number, date of birth, to create fraudulent tax returns, and certainly to take advantage of you. We saw, during the course of the tax season, a number of emails intended to try and trick us as well. Folks that were emailing us and saying, "Oh, I need a tax preparer. Just click here and you'll have all of my tax documents." We saw a number of those this tax season. So it is out there, and it is so pervasive. You just have to be so careful of the information that you're accessing. That's for sure.
Definitely. And next, almost along those same lines, is don't get your tax advice from social media. Now, while it's not quite a scam, it can be pretty close, because these folks are not experts by any means. And with something as complex as our tax code, as with many things, it is very important to make sure you're getting your advice from an expert, and not these folks on social media who are really just looking to, grab your attention and use shock value to get some clicks and likes and follow them and, all those good things that you do on social media.
Yeah, let's not forget, their business is not to provide tax advice and to get paid for it. Right. Their business is how many likes can I get, how much viewership can I get, and then that way I can get into product placement, and that's ultimately, those are advertising sort of channels or business models. They're not based on providing that service of preparing tax returns or giving tax advice. So big difference there. And I guess to kind of really summarize all of this up, and this was something I talked about at length on a program a couple of months ago, that gets us to the IRS PIN number and why that is important to really do that. And when we talked about it on a prior program, I actually went and did it myself personally, so I have an IRS PIN number. And what that is that is an option where you can go to the IRS and say, "Hey, I want a PIN number that is unique to me." It's unique every year, right? Mm-hmm. They'll redo it every year.
Every January, you'll get a new number in the mail.
Perfect. So what that means is that I guess the best way to describe it is that sort of enables this two-factor authentication. Mm-hmm. When it comes to the filing of your tax return, and certainly a pretty important issue to really delve into and to make sure to use that as a technique to ultimately ensure that your information is more secure than it ever has been. That's for sure.
Yeah, and it really started with several years ago. We had so much identity theft on tax returns. People were trying to file returns and get your refund before you did. And that's where the PIN came about, and now it's expanded to pretty much anybody could get it if you want it.
Yeah, and what's shocking is only like 5% of the population have that. So there's a lot more people that could be taking advantage of that to help protect themselves. If you're interested, you just go to the IRS website. You'll need to have open up an IRS login registration account, and then you have to go to ID.me as well in order to make that happen. So it's a little bit of a process. It's not super easy, but then again, it's designed to create a higher level of security. So you don't necessarily want that to be super easy, because then it makes it easy for bad people to do that.
Yeah.
So,
and the problem lies where every year you have to now have that PIN number. So if you don't have your PIN, when we go to file your tax return, it rejects it. It will not let us file without it. So the issue is you just have to make sure you're keeping up with that every year.
So really some great advice sort of running the gamut of when it comes to your taxes, things to be aware of and to look out for, particularly this past season, sort of trouble spots, if you will. Shifting gears a little bit, you and I had the honor of being able to go to a lunch, and we were the featured speaker at a plan giving luncheon put on by Heart of Florida United Way this past week. Certainly covered a lot of territory in that conversation.
We did. It was a lovely building that they have. I never even realized that was over there.
Right down there in the packing district. So right in the middle of the heart of a lot of building that is happening here in Central Florida. For those of you who don't know and are unfamiliar with Heart of Florida United Way, they've been serving Central Florida for 85 years, in fact, and certainly do great work at improving the lives of individuals and families by creating and uniting people and organizations to kind of create a lasting impact. In fact, they impacted more than 750,000 individuals in their respective households in Central Florida. And certainly their 988 suicide and crisis lifeline potentially saved nearly the 14,000 lives. That was the number of calls that happen to their suicide and crisis lifeline. So certainly a significant community partner.
Yeah, absolutely, and a major contributor to our community here in Central Florida.
Absolutely. So one of the things that we talked about was sort of some strategies, right, for successful charitable giving. So we thought we would spend some time sharing with you, our listening audience, of the program here, Dollars and Cents, to what we talked about on during that luncheon seminar. I guess we started with the easy one, right?
It is the easiest one for some folks, potentially, and that's just write a check, if you still have a checkbook,
right.
That is.
Or you got to use a QR code or a credit card or something like that. So that certainly has changed a little bit, but obviously that's easy. So we always like to make sure, we start with the obvious, which is if you want to donate money, easy enough to donate money. The next one, Christina, that's one that I know you do. You help a lot of folks at the office do this next one.
Yeah, so that is a Qualified Charitable Distribution, or also known as a QCD. This is where you take a distribution from your IRA, make the check payable directly to the charity, and it makes that IRA distribution non-taxable to you. So this is a newer option. It has been around for a little bit, but it's just become more popular. To where you can take money out of your retirement accounts starting at age 70 and a half, because if you remember, that used to be the RMD age, so it's not 73. You can take advantage of it at 70 and a half. It was originally introduced in 2006, but it was made permanent in 2015, and that's where you really started to see a little bit of the uptick of folks utilizing this option. How it works is you reach out to your IRA or retirement provider. You would complete their redemption paperwork to make a check payable to a third party, which would be the charity. Once you complete that, it goes to the charity, and then on your tax return, you get to disallow that retirement income as being taxable to you.
Certainly a very, very powerful vehicle. It certainly helps folks avoid some of the income adjustments that can happen as it relates to their Medicare payment. And the reality is you can do much more than your RMD. You can actually go up to $108,000 $6,000 of qualified charitable distributions for the year 2025. So it can be more than your RMD. It's often thought that it sort of relates to it, but there's some different rules on it that give it a lot more flexibility than just that.
Definitely.
We're going to take a break and continue here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. So we're covering some of the successful financial strategies involving charitable giving that we were pleased to give and share with a special luncheon that was put on by Heart of Florida United Way this past week, where we were invited as the featured speaker. The next one on this list, before the break, we were talking about just donating by cash. And then, of course, Christina, you were talking about the qualified charitable distribution, a pretty powerful option. The next category is sort of the notion of gifting appreciated assets, and this one's been around a long time, and what it does is, like, let's say that you were happy or lucky enough to buy some shares in Microsoft when Bill Gates was like a 20-year-old, and now you have a massive capital gain on those shares. And so if you sold those shares, then you would have a capital gain that you would have to report and pay taxes on your tax return. But if you gave those shares directly to a charity, then you get the full amount as a charitable deduction of the value of that stock that you gave. And then you don't have to worry about the capital gain part, because when the charity then sells it, and normally that's what charities do when you give them any type of investment, they immediately kind of convert it over to cash. And ultimately then, because the charity is a nonprofit, then they don't have to pay the tax on that capital gain. So the notion of gifting an appreciated asset like that, I think, is a really powerful one. That one's been around a long time, but I think sometimes people forget about that one and the power that comes with that in terms of sort of those tax saving opportunities.
Absolutely. Next, we have deductions through bunching. So post 2018, it was much harder to itemize on your tax return because the standard deduction is just so much higher. So for 2025, for a couple over age 65, your standard deduction is going to be over $33,000. So to itemize, it's your charity, your mortgage interest, property taxes, and maybe medical if that applies. So for many folks, you come nowhere near the $33,000 that you would need to itemize. By bunching, you would make your donations in 1 year. Basically, if, let's say for 25, you don't make a donation. And then in January of 26, you would make your 25 donation. And then in December of 26, you would make your 26 donation. So in essence, you're counting 2 donations in 1 year. Right. The preceding year, you then wouldn't make a donation. And this way, you would get a little bit more of the tax advantage side, hopefully be able to itemize by doing it this way. And you can add on other itemized deductions by doing this, like your property taxes. You could bunch them in the same year. Or maybe you need a car sometime. You may wait 1 more year to include it in your bunching year to really compound the power of itemizing.
That's a good point, Christina, is this bunching concept really does apply to all the other things that you would itemize your deductions on, whether that's real estate taxes or personal property taxes, but particularly with charitable giving. And obviously this is a strategy post-2018 when the standard deduction became a much larger number, that folks would often find that they've got an opportunity here with some proper planning to be able to kind of save a little bit more on their taxes, particularly since nowadays the standard deduction is so high. I mean, well over 90% of the population just takes the standard deduction. So you don't get that itemization which you used to do. The next one is another area where legislative changes have sort of changed sort of the perspective on it, and this is the notion of naming a charity directly as a beneficiary on a particular account or a particular investment, so that when you pass, it goes automatically to that charity, and then obviously you have that charitable write-off for income and state tax purposes. The reality is that it used to be where when prior to 2020, when people inherited a retirement account, they had the rest of their life to take that money out a little bit at a time, and the remaining balance of the account would continue to grow on a tax-deferred basis. Now, of course, post-2020, Christina, is a 10-year rule. So what's interesting is that if you name a charity as a beneficiary specifically on a retirement account, then you've really avoided a tremendous amount of tax for yourself, while at the same time giving a nice charitable gift to a particular charity when you pass. So pretty powerful using this direct bequest method when it comes to retirement accounts. That's for sure. So a great way to kind of be thinking a little differently on what the options might be on something like that.
Yeah, and a lot of folks sometimes don't realize it doesn't have to be your 100% beneficiary. You can leave 5% or 1% or 2% to a charity. We get that question all the time. So keep in mind, it doesn't have to be your whole account.
Well, and details matter on that. We talked a little bit about that at the luncheon. Details matter on a lot of the stuff, whether it's qualified charitable distributions or direct bequests. Make sure you got the name right.
Yeah. Oh, definitely.
Okay. Make sure you know exactly where it needs to go.
Address.
And then if there is some changes, then you want to certainly update all of that. We've certainly run into issues where we're kind of left chasing or scratching our heads as to which part of the organization or which organization did they mean. I understand, puppy love is, great, but which particular part of that were we going for? So be careful. Details matter, as they do in most anything when it comes to your investments.
Another option is a donor-advised fund, or DAF accounts. These have become increasingly popular lately, and they grant you some flexibility regarding charitable funding accounts and being able to make a larger contribution now when you may not even know exactly where you want to donate those funds. Over the past 4 years, we've seen a double in the assets under management in these donor-advised funds. So for 2023, there was almost $250 billion in these donor-advised accounts. Yeah,
becoming a much more popular just globally across the country. And they are, I think, very powerful in that whatever you put in, you're going to get that immediate charitable deduction, all right? And then you can decide later that year, next year, 5 years down the road, whatever the case may be, which charities you ultimately want to have that money go to. This is a particularly great strategy when you've got a year where maybe you've got a little bit higher income. Maybe you sold an investment property, or maybe you sold your business and have a huge spike in income, but you haven't had the time to figure out, okay, which charities am I going to wind up supporting? The donor advised fund really allows you to be able to put that money in, get a big charitable deduction, and then figure out which charitable organizations you want to support later on. So very, very powerful stuff. And this one you can also fund with appreciated assets as well. So I know when I set up one, I use a growth fund that I had owned for 25 years. A little bit more paperwork on that.
It was.
When you do that. But still very valuable to be able to kind of combine a couple of these strategies all into one. That's for sure. Similar to donor advised funds, another option is sort of a family foundation. Those have become more and more popular. Total assets in private foundation these days about $800 billion. And the reality is that a private foundation, obviously much more complex, much more expensive to maintain than a donor advised fund. Private foundation generally a little bit more intergenerational, gives you the opportunity to maybe help impart some charitable giving principles to future generations as well. But certainly one that certainly holding a good bit of money in the private foundation side as well.
Yeah. So you basically get the deduction now, but just be prepared for a lot more paperwork. It in essence becomes its own little business.
Sure. No, absolutely. Separate tax return, separate administrative, all that kind of stuff. Last thing that we mentioned was this notion of CRATs, CRUTs, Leeds Trust. It's sort of like multiple variations of sort of an alphabet soup of options that depend on what's donated, what kind of income you want, or what's expected in return. So which option you sort of pick for those types of more trust or related types of parameters depends on kind of how you want it to get set up. So really kind of an alphabet soup there, if you will. So whole lot of options. Certainly appreciate the opportunity to be there at the luncheon at United Way. Very nice indeed. With that, we're going to wrap it on up and get on out of here. Thank you for listening to Dollars and Cents. And we will be back next week, as always, with a host of new topics for you to help improve your life with a successful and cost-effective financial plan. If you think we can be of help to you this week, visit our website, nelsonfinancialplanning.com, and schedule an absolutely free conversation.